Stocks added to Thursday's losses as investors suffered the jitters over tightening of financial conditions in the face of a multi-decade high inflation rate. Further, geopolitical concerns between Russia and Ukraine and soaring oil prices didn't help much. Along with stocks sinking, the benchmark 10-year Treasury yield turned lower after breaking above 2% for the first time since August of 2019. The surging 7.5% jump in inflation begs the Federal Reserve to raise interest rates more aggressively than expected and begin rolling assets off its balance sheet to curb liquidity. And with that came the speculation of an emergency rate hike that rattled the markets. But late in the day Friday, the Fed effectively killed any speculation for an early rate hike when it published its Treasury buying schedule. It reads that $20 billion in Treasury bonds will be purchased across 8 operations over the next month. The final purchase will be $4 billion, taking place on March 9th, and this is in line with previous expectations and 1 week before the March 16th Fed meeting, when the Fed will likely hike rates by 50 basis points or 0.5%. So, what do the charts look like? Today we're going to look at 2 quick charts, beginning here with the 1-year daily chart on the spiders, the SPY, and the close on Friday was 440.46. And as you can see from this top here, we came on down here. We bounced off of just above 420. Up here we've kind of meandered sideways a bit, but I think we're coming on down here, perhaps next week maybe a little bit further, and then I expect one other bottom and then the bounce off of that. Now, that W formation we've seen many times. Going back here, you can see down, up, down, and then away. A small formation here, up and away, and then another formation a little bit larger here, up, down, and then up. They're not perfect, but you can see down, up, down, and then on our way up. So we have another W formation, in my opinion. I think that is the probability. Let's take a look at the oscillators moving on down. Volume's not showing too much here in the MAC. From that point there, we came on down. We recovered. I think we're going to head back down again. Not sure exactly how far before we head back on up. We're relatively weak under that 0 or midline. Same thing here in the histogram. Of course, the price rate of change. We've come down here, back up here. We're struggling with that 0 line. I think it's going to fail and head back down and then perhaps on up. So these formations are showing up not only in the price chart, but in these oscillators. You can see stochastics. Looks like it's turning over here with the fast line, about ready to go through, move on down. I don't know if it's going to go below that 50 or midline. It may or may not. That really isn't the point. Same thing here in the Williams. I think the overriding characteristic is in the price chart, and that W formation is relatively easy to see, and that's my expectation. I think that's the probability for now. So now let's go take a look at the monthly chart. And we're now looking at the 20-year monthly chart on the SPY. And this chart we've looked at a number of times, and the danger that we see here is on our way up, we've topped, and we're on our way down. And we're elevated above that 20 and the 50 EMAs to the point that it's possible that in the future we can come down and test at least that 20 and maybe the 50 EMA. We've seen that before here where we went below. Here, hit the 50, back on up. Here, hit the 50, back on up. Here, slightly below. And of course, in 2009, great financial crisis, well below that 50. So there is a possibility that we can continue on down here. I think the short term, again, is we're going to recover. But in the longer term, we need to watch out for this, simply because when you take a look at the MAC, we are rolling over. And if that fast line goes through the slow line, fast line being black, the slow line being red. If the fast line goes down below that slow line, we could have some real trouble. And it looks here in the histogram that we're heading on down pretty quickly. So that is a red flag. Price rate of change we've already come through. Relative strength, we're heading toward that 50 or midline, and as well as in the stochastics. Now we've stayed above that 50 or midline in each of these other pullbacks or corrections, so I think that's the most likely, but that still can be painful. You can see it here, there in the Williams, and then back up to the price chart. So that is the danger. I think it is a real danger, and the probability is increasing as we march toward that period where the Fed is going to start raising rates. So beware and save some cash for those opportunities. And for today, that's ChewDog Charts. Thank you.